Discover the secrets of the legendary investor Peter Lynch and unravel powerful strategies for picking stocks wisely. In the texts above, we explore Lynch's 3 fundamental principles, a master who turned a $20 million mutual fund into a $14 billion giant. Want to know how he achieved that? From only invest in what you understand to the art of investing for the long term, we unravel the path to solid investments. Stay with us to explore fascinating details of Lynch's unique approach. If you seek to multiply your knowledge in investments, sign up now and don't miss out. Peter Lynch. How to pick stocks. Let's venture together into the universe of smart stock choices. Subscribe, hit the bell, and let's go! 3. Only invest in what you understand. Peter Lynch's first investment principle highlights the fundamental premise of only invest in what you understand. Lynch, a respected portfolio manager in the 1970s and 1980s, argued that the inherent advantage of individual investors lies in their ability to discern information that escapes large financial institutions. His philosophy was based on the idea that by investing in companies whose operations are understandable to the investor, one acquires a solid foundation for making informed and reasoned decisions. Lynch's vision transcends the conventional conception of investment by suggesting that the act of investing should be intrinsically linked to a deep understanding of the underlying business of a company. He urges investors to employ their senses, such as eyes, ears, and logical reasoning, in the process of identifying investment opportunities. Lynch believed that everyday life offers numerous clues about potential investments, whether walking through supermarket aisles or during casual conversations with friends and family. By expanding the scope of this approach, Lynch suggested that individual consumers, representing a substantial portion of the economy, play a vital role in the stock market. If a product or service attracts the consumer, Lynch argued, it not only reflects their preferences as a consumer, but also potentially signals an investment opportunity. This principle highlights the importance of demystifying the investment process, making it accessible to all investors, regardless of their experience. At the core of Lynch's philosophy is the conviction that direct understanding of the environment around us is a rich source of insights for investments. He encourages investors to incorporate simplicity and intuition into the decision-making process, emphasizing that the key to success lies in consciously choosing to invest only in what is fully understood. This approach not only democratizes investment, but also reinforces the idea that by demystifying financial complexities, investors can achieve more solid and sustainable results over time. 2. Always do your homework. The second fundamental principle of Peter Lynch, a renowned investment manager, is encapsulated in the imperative maxim of always do your homework. For Lynch, diligent research is grounded in the premise that the search for investment opportunities goes beyond superficial observations and requires deep and careful analysis. He advises investors to transcend apparent simplicity, highlighting that even the best ideas need a solid foundation to become prudent investment decisions. Lynch, notable for his astute management of the Magellan Fund, outlines specific criteria for intelligent research. He emphasizes the importance of evaluating the percentage of sales represented by a product or service, stressing that the relevance of this aspect should be significant enough to impact a company's financial results significantly. Additionally, Lynch introduces the PEG ratio, price earnings to growth, highlighting the need to understand how much of the growth expectations are already incorporated into the stock price. His value-oriented approach seeks to balance growth potential with a reasonable valuation. Another highlight in Lynch's research is the preference for companies with robust financial positions, exemplified by strong cash flows and debt-to-equity ratios below average. These criteria reflect his belief that well-managed companies, maintaining prudent financial management, are better positioned to navigate different market scenarios. Lynch reinforces the idea that while intuitive and anecdotal observations are valuable, they should be complemented by in-depth analysis to substantiate investment decisions. By incorporating these principles into his research strategy, Lynch aimed to offer investors a comprehensive method for identifying promising stocks. His emphasis on diligent research not only highlights the importance of critical analysis, but also reinforces the need to base investment decisions on objective criteria. Ultimately, Lynch's second principle seeks to equip investors with the necessary tools to assess the true potential of a company, going beyond surface appearances and incorporating robust analysis in their search for investment opportunities. 1. Invest for the long term. The third and crucial investment principle of Peter Lynch is encapsulated in the wisdom of investing for the long term. Lynch, known for his exemplary management of the Fidelity Magellan Fund, challenges the frantic pursuit of immediate results by stating that, in the absence of extraordinary surprises, stocks exhibit relative predictability over extended periods, spanning 10 to 20 years. This perspective contradicts the common mindset of trying to anticipate short-term movements, emphasizing the importance of maintaining a broader and more sustainable view in investments. Contrary to the inherent volatility of short-term fluctuations, Lynch emphasizes the intrinsic predictability of stocks over time. He advocates the prudent approach of avoiding futile attempts to predict market swings in shorter periods, as the true strength of stocks, according to Lynch, unfolds over a longer time horizon. This philosophy resonates with the idea that the true value of a company manifests and solidifies over decades, allowing astute investors to reap the rewards of their solid long-term choices. A striking aspect of this long-term approach is the resistance to market frenzy and the temptation to try to time stocks for quick profits. Lynch, in a notable study, demonstrates that attempting to predict the ideal times to buy and sell often results in lower returns. Instead, he emphasizes the importance of holding on to solid companies and resisting the temptation to give in to momentary impulses, relying on the premise that, over time, the solid performance of resilient companies will prevail. At the core of this long-term philosophy is the resistance to the trend of selling stocks prematurely, even in the face of appreciable gains. Lynch, coining the term 10-bagger to describe stocks whose value increases tenfold, highlights that true success lies in holding on to these stocks, even when they show remarkable growth. His warning against the common practice of selling stocks after moderate gains underscores the holistic view he had of investment, where the true potential of stocks unfolds over time and not in fleeting market movements. Concluding our journey through Peter Lynch's investment principles, we delved into the insightful strategies that transformed a manager into a legend. We learned the importance of only investing in what you understand, the art of diligent research, and the visionary outlook of investing for the long term. If these insights resonated with you, don't forget, knowledge is the true currency of financial success. If you found value in this content, click the like button, share with those seeking growth, and of course, subscribe for more insightful analyses. Leave your comments below. We want to hear your opinion. Together, we will build an enriching learning space. Hit the bell to not miss any details. Here, in the continuous pursuit of financial excellence, we are a thriving community. Thank you for being with us.